Good morning. Thank you for joining our webinar this morning. As we hurtle towards the end of 2022, you may be wondering what just happened in the last year. And you are absolutely correct. What a year we've just had. We had transitory inflation that became sticky inflation. We had SPACs that were forecast to be the next big thing for listed investments. We had cryptocurrencies and NFTs that were going to be the next big thing to giving us 10 times returns on our investments. And how wrong many of us were. In the last week, we saw Elon Musk succumb to pressures to fulfill on his promise to buy Twitter. And in that time, we also see what has played out from a Twitter and NFT perspective. So the first tweet that was ever tweeted was by Jack Dorsey, the CEO of Twitter. And that NFT was sold for $2.9 million. Today, that NFT has a bid of $280. In anyone's books, that is 100% loss on your investment. And so, how the world has changed. We see central banks around the world accelerating interest rate hikes like never before in a precedent to try to keep inflation under control. So as we move into a world running out of opportunities to make money out of half-baked ideas, we are heavily focused on a slowdown in global economies, geopolitical tensions globally, from Russia, Ukraine strains, and supply constraints on goods and services around the world. And of course, like I previously mentioned, the uncontrollable inflation that we see all around us. And as we look at this complex world we live in, maybe it's suitable to remember the quote by hockey player John Gretzky, who said, "It's better to play the puck where it will be than where it is currently." So should we be fixated on runaway inflation? Shouldn't we be thinking what is coming next? And all of that will be unpacked in our session with our Chief Investment Officer and Head of Investment Management, Dr. Adriaan Pask. And so I look forward to the session with Adriaan, and I hope you find this valuable. Over to you, Adriaan.
Good morning, everybody. Thank you very much for having me. Welcome to those in the audience and at the venue, and also a warm welcome to everybody joining us online. So these quarterly investment updates, typically what we try to do is to give some insights from what we wrote about in the research and strategy report that we publish on a quarterly basis. So I'll do the same here today. Just give you a few extracts from the message in that document that's gone out. It went out to advisors on Tuesday. The intent is to send it out to clients in a week or two. So please have a read. There's a lot of effort that goes into preparing that document for our advisors and clients. We'd really appreciate if you can spend some time with it. Obviously, being a investment update, I will provide some asset class views. And in particular, I think it's worthwhile spending some separate time on the US dollar. That's most likely to be one of the more significant stories in the coming months. US inflation and rates, a bit of a counter perspective to the narrative that's out there at the moment. Not to say that the view that I will put down is the base case view, but I think it's important to keep in mind what the range of possibilities are when it comes to that topic in particular. And I'll end off with portfolio implications, just to give you an indication of how we have seen some of these events play out in our portfolios and the impact and what we see or what we expect will happen in the coming months and years. So from the perspective from the RNS is really to say, it's a debate that's been raging on now for multiple years, offshore investing versus South African investing. We've adjusted our view in the advice for advisors to say we think that where the balance over the last 10 years has been to allocate offshore, we think that it should be a more equal allocation between South African and offshore assets. And in particular, where our investors build up a lot of capital is in the US base, because those are the investments that have done extraordinarily well. The US has outperformed the rest of the world significantly, and I've got a few charts that I can show you that shows that quite nicely. But the argument that we're making is to say that these things are typically quite cyclical in nature. No region remains a favorite throughout time. And at the same time, we think South Africa has obviously been through a very tough period now for a prolonged period of time. And sentiment is really having a significant impact on our valuations in particular. And the charts and tables and diagrams that I present in this section specifically speaks to everything that's included in the note that I wrote for the research and strategy report. But what you can see is, yes, obviously we are struggling with a significant unemployment problem. And there's no way of getting around it, and there's significant challenges that's introduced. We sit with poverty, social issues, not enough people contributing to growing the economy, the tax base, etc. And these are all well-known issues. But if we really look at some of the other macro factors at play, and some of the valuation factors that come into play as well, it does provide a reasonably interesting perspective. So if we look at our debt to GDP levels, for example, you'll remember through COVID, we thought, if we look at government revenues, it was really dismal. We had no growth and a lot of welfare spending going on, which is needed for the country where it is at the moment, but it puts us under enormous strain. And there were projections that you'll remember they issued that in the budget speech where there was a high road and a low road, and it looked at optimal cases we were heading for 100% debt to GDP. Today that's flattening off and we're under 70% GDP, which is actually below the OECD country average. Largely to thank for that is the higher commodity prices, which has helped quite significantly on the tax roll. But nonetheless, we understand that that won't last forever. But if we look at where our debt to GDP stands at 70%, under 70% versus many of the countries around the world, we are significantly better poised. Not in a good position, but definitely not as bad as what we see in some of the other countries. Many developed markets around the world currently sit with debt to GDP ratios that are incredibly high. Well north of 100%. You can see in the US case 140%, and it's not even the highest out there. At the same time, we see bond yields move up significantly. So you can imagine what's happening to the funding cost of this debt. It was not so long ago that our 10-year US bond was sitting at 1.5%. After the recent rate hikes, we're looking at 4.5%, 5%, where we're going to end. So obviously your debt financing rate has tripled, and at the same time, your debt levels have tripled. If you were an individual and your debt profile looked like that, imagine your debt cost of your home increased by 3 times just in terms of what's outstanding on your mortgage bond, and then at the same time, the interest expense also triples. That would be crushing, and I think this is often underestimated part of it. So we don't have any of that severity in our numbers. Inflation rates broadly around the world, we know that we're sitting with a stagflation problem at the moment. Lower growth, and then obviously very high inflation numbers. If we look at the primary budgets, we're actually doing reasonably okay. People forget that the US at the moment is actually in a significant shortfall still, so the debt keeps racking up as long as that number is low. Our current account numbers look good, again, thanks to commodities for helping us quite a bit in that space. Our PMI numbers are fluctuating around the 50s, as with many countries out there at the moment, so I don't think there's much in that. Our cash yields are accelerating quickly, so this is good news from an investment perspective on the cash side of things, because obviously now we have cash helping the other asset classes to generate some returns for clients. So it looks like our cash yields are moving higher. We were speaking to some fixed income managers yesterday, and it looks like you can get an 8% NCD at the moment on your portfolio. So that's already fantastic news for clients who are in multi-asset portfolios. So you can introduce, again, some capital stability through cash, and at the same time, it doesn't come with a massive opportunity cost. Our 10-year bond yields at around 11%, where in the US they're trading at around 4.1%. So you're getting a significant premium to invest in emerging market debt at the moment, and we think those are very attractive valuations. If we look at the valuations of our equity markets, forward price earnings of below 10 is always quite attractive, and in the US at around 17. So that's come down a lot. We've been quite vocal around US valuations in particular, saying that we think that there's way too much froth. They have come down significantly. 16.7 seems more reasonable, but worries me still is the level of optimistic consensus forecast through analysts out there at the moment, and I'll show you why that concerns me. If we look at the dividend yields at 5%, very attractive. our profit margins for South African companies are actually higher than for US counterparts, which I think would surprise many out there. And that's largely, again, also the commodity companies are doing incredibly well at the moment. So the profit margins are good. Earnings yield, so that's just the earnings over price, as expressed as a percentage, or ultimately the inverse of the PE. And again, that's just to say, even if our PEs don't go from the 9.7 to 12 or 13, which we think they could, even if they stay as low as this because sentiment remains low, you will still get the earnings yield of 10% that comes out of that. If the price doesn't move, it essentially means that the PE will continue to reduce by 10% every year, which is unsustainable. And that's why we think we are reaching very low levels and we are well poised for a rebound in this space. And then on currency strength, I personally think these forecasts are slightly conservative. There are numbers that came through from GMO, a research house that I often use and consider quite well versed on the topic. And you'll see from the numbers that are in the dollar section, currently they view South Africa's currency as 10% too cheap and the dollar as 17% too expensive. So we've got to be very careful in terms of how we balance our portfolios. And part of the argument in the RNS report is specifically to say that. So don't worry too much about the text on the screen. The message of this in the document is to say that we think the playing field has leveled out significantly. So if we look at inflation, it's around the world everywhere. If we look at interest rates, it's moving higher everywhere except for in China. But China has other issues. They've got property market ails and they've got policymaker ails. In the US, we've got valuation issues still, and obviously the bond market's under pressure and there's fears of a recession. In Europe, we sit with a war and growth fears. So all of a sudden, it's not just South Africa that feels like the whole world is falling, like our little world at least is falling apart. Everybody globally is feeling the pressure. And we can definitely see it in asset class valuations coming down quite significantly. So the bad news is living through this period is not fantastic. I think we all can attest this year has been pretty dreadful from an investment perspective. It hasn't felt nice, results haven't been great. But these periods typically form the foundation for the next bull run. Markets don't move in linear ways. So eventually you need to move down lower through the cycle and get ready for the next bull run that will inevitably take place. And I think that's incredibly important to remember at this point in time where we feel down and out and we don't see any prospects for investments. Typically, that type of situation makes for very attractive entry points into markets, which speaks to this specific diagram. Obviously, I know many of the guys in the audience have seen this already, but I think it's a very good concept to land with clients at the moment. I think we're all in that fearful space at the moment. But as I say, that's where the foundation will lie for the next bull market rally to form. So we think actually we are sitting with the opportunity in the making at the moment. And from a valuation perspective, we always felt like South Africa is offering good value. Last year was actually a fantastic year. People forget it. People often say, when I speak to them casually over a coffee, they say, you know, it's been a terrible time in markets for a long time now. Has it? Has it really? What happened last year? Just go back to them, look at the numbers. It's actually been that terrible. But we always think about the last 6 months, and that seems to condition our thinking about markets all the time. So I think we're pretty much firmly in the fear space or very close to that. And that's why we are more optimistic. And we see, as those playing fields have leveled out, it's opened opportunities. We see bond yields that are offering much better value locally and abroad. We see cash rates contributing to the portfolio. And we see equity valuations becoming more and more attractive, not only in South Africa, but in other regions around the globe as well. So we are actually in a position where we can diversify our portfolios better and get better returns over the next cycle that's coming our way. Again, just to supplement that, market cycles. So obviously there are risks and opportunities connected to each. And it's funny how many clients think that we're actually in the risk stage of the cycle at the moment. So many risks out there. We're actually thinking we're in the opportunity phase of things, over pessimism and fear. Where we sit with on the risk side of things was actually a few years back. It was when everything was lovely and no one was expecting any trouble. That was when we should be very concerned that there's risks because there's over-optimism and greed. We saw Bitcoins, Nadev mentioned in the introduction, around the speculative investments. Those were classic signs that investors were becoming too greedy. As those things have sold off, we've moved into the opportunity phase of things. So I think we actually have good reason to be reasonably optimistic. If we look at what happened to the S&P, so this graph in grey tells you what the S&P did for each calendar year, so for that 12-month period, and the red dot explains what the drawdown was, the maximum drawdown within that 12-month period. And you can see currently the market is at the end of October, is at minus 19% for the S&P, and the drawdown at its worst was minus 25. That was end of September, and then obviously at October we saw a little bit of a recovery again. But this is actually nothing new. Look at how many of these drawdowns we've seen over the past. Just 2 years ago we saw one, and 4 years before that we saw one, and just before that we had GFC and so on and so forth, and these things are perfectly normal. But the key message from this is really to understand that drawdowns are to be expected. This one isn't the worst one in history. It's actually perfectly normal, and by history standard actually still quite muted. And ultimately, there are more bars at the top than at the bottom. But we don't know when the bars will be at the top and when they will be at the bottom. But we know if you hold on to it through the cycle and invest for the long term, you should be okay. So that's really the message from the RNS. In terms of the asset class views, again, a very interesting chart that GMO issues every month. I always find it incredibly interesting. So this is really their forecast for real returns from various asset classes around the globe over the long term. So you can see for US large equities, for example. So this is typically the big tech companies. Still, even now, that they've sold off, the expectation isn't for phenomenal returns. Inflation beating returns, yes, and the inflation assumption here is for 2% still. So they use the long term. So that's not where the opportunity is going to be according to this assessment. That's the one observation. The other very important observation is that according to the valuations, very similar to the table that I showed you with the green cells, is that they also think emerging markets is the area to be, and emerging markets that are offering value. And that is 100% South Africa's case. So according to this assessment, they think that the real returns could be quite attractive. The other component is emerging debt. So again, emerging markets offering value in the emerging debt space. And if you look at US bonds, for example, even though the yields have moved up and there looks like there's better value out there, according to their 7-year view, so this is a 7-year view forward, still fairly muted. So you can imagine we are, again, quite excited about the prospects for a multi-asset portfolio in South Africa in particular, because all of a sudden our local equities are offering value, our emerging bonds are offering value, our cash rates are going up, and our offshore exposure has less risk because the valuations have come down. So I actually think we're in a much better space than what people currently at least feel. So to summarize, I'll focus on the emerging side of things, particularly in South Africa. What we think is good, cash rates have been historically low. So how this chart works is if you're under the line, it means we're slightly underweight, or if it's blue, it's slightly overweight, and depending on how many bars there are, would give you an indication of exactly how negative or positive we are on that specific asset class. Cash we've been historically not that optimistic about because inflation is high and the cash yields were low. That has been gradually moved up, and when we review this again next month, it's incredibly likely that we'll make it more neutral as rates are closer to their long-term average. Government bond yields look incredibly attractive, as I've mentioned. Credit offers yield, but the opportunity isn't as great as what it was over the preceding cycle. And there's other risks like liquidity that needs to be kept in mind. Property, very similar. We think that there's actually fantastic value in there, but it is a risky area to play, and you're going to have to be very, very selective. And then in the equity space, cyclicals are not specifically commodities, but also things like banks. And I'm pretty sure Vaughan's going to give you more detail. It's something that we discuss in the equity team at length around the outlook for banks and commodities. And defensive, we think, is actually maybe slightly different to defensive from what most would understand. I think our view on defensive would be things that have more stable profit margins that won't be so much affected as costs escalate. So we think the inflation problem is very real for businesses at the moment, and they're going to eat into profit margins. So if you can find a business with very stable profit margins that they can defend, then you can limit the damage to the top line, so in terms of sales. So that's a very defensive way of looking at it, and that's where we are and have been for a while, for a moment, for quite a period. And then the other defensive property that we've brought into our portfolios is also, again, on the valuation side. Investing in some of the things that aren't necessarily most loved, but they offered a lot of margin of safety on the valuation side, and that's worked reasonably well for us over the last 12 months. In developed markets, defensive equities, so we shifted out of growth in both the fund solution side. We made some moves to focus the portfolio closer to value type managers, and in our equity mandate that we run on the equity side, we moved our own portfolio in a similar way to be more value focused. On the property side, more or less neutral. Bonds we haven't liked for a very long time, especially US bonds, and we've now seen some of this now come through as the bond yields have started to rise. And then on the US dollar, we just think is incredibly strong at the moment. I think, as I said, the 17% that GMO is probably conservative, but it's a very difficult thing to call currencies. But I think there is more or less consensus to say that the currency is quite strong there. And then on the sterling and euros, obviously then in relation to the dollar, relatively attractive. If we look at the S&P, so what's happened? You'll remember this is more or less over the last year or so that we've said we're getting increasingly concerned about valuations on the S&P. It has sold down a lot. The multiple has moved from where it was previously around, say, the 22, 23 level to 16.7. That's the same number I had in the table up front. But what worries me is it's important to notice that this is a forward PE. And Vaughan can give you an indication of the discussions we have on the historic and forward PEs and how you should be fairly suspicious of forward Ps in our view. If you look at what the outcomes typically are, so the chart on the left looks at the subsequent 1-year returns. If we look at the PE multiples where they are as an entry PE, what should you reasonably expect? Over 1 year, markets trade on sentiment. So valuation is not going to matter. The R squared on this is very, very low, so it means there's very little statistical relevance. But if you start to look at the 5-year number, you can see there's a strong relationship. If you overpay for stocks, you get poorer outcomes. If you pay less, then the odds are a little bit better. It wasn't too long ago that we were on this 20 multiple, and we felt like the outlook over the next 5 years could be fairly flat. Where we are now, it makes a huge difference. Just to be in the space where we are at that 16.7 already means that you've limited some of that downside that we would have experienced previously. We've essentially paid the cost up front over the last 6 months. But now that's out of the way, so we've got to think again about how we view offshore markets. And this is the graph that really concerns me. So this is the S&P 500 earnings per share actuals versus the consensus analyst estimates in blue. And you can see essentially what consensus analysts are saying is that we're going back to a level of earnings growth on the S&P that's essentially 50% more than what it was pre-COVID. And pre-COVID was fantastic. The longest bull run in history. Unemployment was incredibly low. US economy was booming. Earnings were very high. And to think that we would have 50% on that environment where interest rates are significantly higher is totally removed from reality. So we think that is a huge risk. So, and this is the earnings multiple that's used in the PE calc. So if you assume that they're wrong and you halve this, then the PE goes from 16.7 to 33. So you've got to be very careful. We're not saying that's our base case, but you've got to work this into your thinking. Otherwise, you can be caught out. And then just back to the argument of why not overpay. We often encounter the argument, yes, but US companies are fantastic. They just continue to grow. Google's not going anywhere. And 100% correct. Earnings growth, 3.5% is okay for the environment, right? So we all knew that they still continue to make money. The problem is they had multiple contraction. So the PEs came in low because the outlook for them got a little bit more uncertain. It was quite easy to say, well, Google will grow at double digits for the next 10 years for sure. Now all of a sudden investors are thinking, maybe that's not the case. Advertising businesses, it might not be the place where people will be spending money during a recession. And the multiples have started to come down. And that has had by far the biggest impact on the returns this year. So we should be very mindful of, yes, we want companies that can grow earnings, but be careful before you start overpaying for them. Profit margins, I've mentioned a little bit already. So profit margins on the JSE around 16-17%, on the S&P around 11% at the moment. But important, if we hit that recession, this actually has a bigger impact than the top line component, so the revenue component. If you hit a recession and your sales goes down by 6%, it's not the end of the world. It's a 6% impact. If your profit margins go from 11 to, let's call it on average during the grey period, say 6 at best, it means your earnings will halve. So we think the profit margin thing is incredibly important in this environment. Understand the ability of the company to pass on cost. If they're not able to pass on cost, they're going to have shrinkage on the profit margins. If they've got shrinkage on profit margins at the top line, it's a very lethal cocktail to the earnings. On the dollar, so where we see the dollar index at the moment, so this is according to the real effective exchange rate, the dollar index currently at levels last seen in the 80s. And this we think is material for multiple reasons. It means that all the other currencies around the globe is cheap relative to the dollar. But very significantly, it means that US businesses that attracted a lot of flows from an investment perspective that are doing business in other countries around the globe need to bring that revenue back into dollars. It's going to have a huge impact on earnings. So even if you make the same level of earnings, but the dollar remains as strong as what it is. It's very expensive to buy those dollars and report your earnings at the moment. So we expect some headwinds in this space. US-focused businesses with a lot of sales outside of their borders that need to bring the money back into dollars will have a very big headwind to fight in the form of the strong dollar. If you look at the G10 currency valuation, so just to be clear, this is not the G10 as you would know it in its conventional form. This is actually the G10 currencies, which is just the 10 most liquid currencies. And here you can see this is where I got the 17% from. The US, by far, given with Canada, the most expensive currency around the developed markets. Interesting to note that it's actually all the ones that are denominated as dollars that are currently overvalued. And then obviously things like Japan and the euro, these are areas that we think are quite interesting because they suffer from, or they actually benefit from the same thing that the US companies are suffering from. So if you can find a business in Japan, for example, that is bringing money back and buying cheap yens to report their earnings, that might be something to look at. But try and find a company that you feel comfortable with in Japan. That's not the easiest thing to do. So that's where you need an equity research team. On the euro side, that's luckily something that we've tried this year, and it's really worked a charm for us on this side. We bought some autos in our offshore equity portfolio, and you can see, again, this will be a significant, somewhat artificial, tailwind for these businesses as they benefit from the weak currencies. And the author of the article that published us, I just copied in the quote. So Ben Inker is the co-head of asset allocation at GMO, and he writes in the piece, countries with substantially overvalued currencies see their equity markets underperform sharply. So take note of that. And at the same time, countries with cheap currencies outperform cheaply. So we think this narrative will start to come into play next year. If we look at emerging market currencies versus the dollar, South Africa feels like it's taking a pounding, but I'm very happy I'm not living in Turkey at the moment. So these are the prospects. So obviously what we would like to do is shop somewhere here where we think the currencies are quite cheap. Some of these business areas are very difficult to invest in at the moment, but we know South Africa. We know the businesses here. We know the management teams here. Our analysts have covered these stocks before. So if we're going to take a chance somewhere to try and generate some alpha, we think South Africa is a good place to start. If you look at the 3-year stock return, so just bringing that argument into actual evidence, so where I said that the earnings will be impacted, what's the impact? So if you look at the currency returns, given the valuation of the specific currency, as we've mentioned. So for example, on the dollar, it's around 17% overvalued. So typically what you would see in the stock market returns in US would then be, say, 11% lower. So that's typically the impact that this strong currency can have on your earnings base. And for the ones that are weaker, so South Africa is in the 10% camp here, typically find a benefit from an earnings perspective. So that's the argument. But then also there's obviously the currency return itself. So if you're investing offshore at the moment and you have to bring that money back later, so if the currency is at 18.30 or 18.40 and you've got to bring it back next year at 17, I know everybody's thinking it can only go in one direction. It goes from 1840 to 1850 to 1860. Next year it will probably be 20, and the year after that probably 22. That's not how the currency works. They're also cyclical, but people forget. Just like they forget that last year was a good year on equity markets, they forget. The rand has had rallies of 50%. It's not unlikely in a situation like we have now, given the strong dollar. US and inflation rates. Some interesting work that was done through the grad that's in my team, FISO. So we've done some work on this, and it was a nice project to work on because I think it's so super important. And it's actually quite simple to get through, but people don't think about inflation in this way. So let me show you what we've done. So this is the CPI index for the US, because that's really the inflation number that really worries us, because that's what's going to influence capital flow through interest rates in a big way. So if inflation remains high, we can expect interest rates to continue to go higher, and we can expect the turbulence to remain. So what we ideally want is for inflation to start flattening off. Ideally, the Fed just to stop with interest rates. But is there even a possibility of a sharp stop and cut? That would be fantastic for markets. So these are the kind of things that we want to understand. And the nice thing about year-on-year inflation, as they report them in the media, is that if you look at the number that was published this month, we actually already had 11 out of 12 of the data points that determines that number. The only one that was missing is the last month. The other month-on-month inflations were printed in the preceding 11 months already, and that made up the inflation print for the year. So you actually have a very good indication, and you actually have fairly good forecasting ability, given that you've got all the historic numbers in there already, and that forecasting ability deteriorates as your inflation outlook extends. So in 12 months' time, all the data that we have now will be out of the 12-month number because it needs to be populated from now over the next 12 months. It's a difficult concept to explain, but let's say, for example, we've seen prices. So this is total CPI in the US on aggregate. We've seen prices go up and move up sharply above trend. We know that there's been an energy crisis. Will the energy crisis last until forever? Probably not. So that's where prices are. And we've actually, to be honest, when we did this exercise, we didn't have this data point. We updated the numbers now for the presentation today. But what we say is, say prices just remain where they are. They're not going to come down. They're not going to continue to shoot and rocket up. They're just going to stay where they are, which means that they're not growing, but they remain elevated. Okay? So that seems reasonable. But if they remain on that level then for 12 months, then obviously inflation for the 12 months is zero, because the prices didn't grow. It's the difference between that point and that one at the end. And still, it's above trend, the inflation, the actual CPI number. So the question that I had, and the challenge that I posed to FISA is there any remote possibility of even deflation? And that's like a swear word at the moment, because everybody's talking about hyperinflation, and even if inflation comes down, it will maybe be 4, 5, 6%. Is there any chance of deflation? So here you can see what happens to the reported inflation, the year-on-year change, if prices remain constant. Then they will move slowly lower down, exactly according to this slope, and then flatten out at 0 in 12 months' time. So now I said, okay, but we can see that this is still above trend. What happens if inflation goes to a 5-year average? So over that period, last 5 years, we've had low inflation, and then we've got super high inflation. So let's just see what a 5-year number does. So if you can look at a 5-year number, and so that's the 5-year average, and we gradually move to that point over the next 12 months. What will the impact be on year-on-year inflation? That means this is the 0% inflation, the first example I did. This is the 5-year average inflation. Actually implies this is a very optimistic case, granted. I mean, we're not going to see prices come down that high. But it does provide some counter perspective to the existing narrative out there that inflation will just continue to remain high. If prices just revert to their averages over the last 5 years, you can see disinflation of around 10%. This is nowhere in news. No one's talking about it. Everybody's talking about inflation. My base case would be that we will at least temporarily be in here somewhere for a short period of time. Until, again, because this is just the impact of base effects. It's just because we created such a massive peak here that the base effects are now helping us. So once that base effect is out of play and you look at something a little bit more reasonable on trend, then that's going to pass. So My base case would be that we're heading for a period where we might see some disinflation for a few months, and then the inflation numbers will start picking up again. It is a very contentious view, and it's definitely not a common view. But at the very least, I'm hopefully open your minds to the possibility that things can be very different to consensus. If that's the one lesson, then that's fine. In terms of portfolio implications, I mean, how do we take all of this stuff and introduce it? I've given you some examples of how we included some Euro autos, for example, in the portfolio, which was actually also at the time a bit of a controversial one to get done. But if you look at what's actually been happening in the portfolios, think of our offshore portfolios. This is an area where we've been taking a little bit of heat from advisors in terms of why are the portfolios struggling. So obviously markets have been tough. But if you look at the conventional thinking of diversifying an offshore portfolio is, say for example, you use a portfolio of offshore bonds and offshore equities. Typically when offshore equities come under pressure, the offshore bonds have been a safe haven and they then start to do well for you. That's exactly what happened in COVID. So equities sold off, bonds shot up. So, and you can see that. So this is the correlation of the S&P versus various asset classes. So over here, you've got correlations closer to 1, and that is means it moves quite closely to the S&P move. Here you've got very little correlation, and here you've got negative correlation. So if S&P 500 equities sell off, you'll see your bonds help you a lot. That's the theory. So it makes sense. You build a portfolio, a little bit of offshore bonds, a little bit of offshore equities, and you should be just fine. And another interesting observation is look at where emerging market debt sits. This is our bonds. So if you're going to sell off S&P 500 equities, you should probably expect emerging market bonds to sell off too. That's exactly what we've seen, actually. But if you look at what happened last year on this relationship, did bonds help us over the last year to protect some on the downside? Absolutely not. So this is a 60-40 portfolio, 60 equities, 40 fixed income. And typically what you would find is if the equity component sells off a bit, then you would have your bonds help you a bit. This year, it's the first time that we've seen a simultaneous sell-off of the equity and the bonds. So the diversification benefit was not only not existent, it's actually detrimental. So for our portfolios like Global Preserver, Global Moderate, Global Flexible, would have felt this pain here because the guys do diversify according to conventional wisdom. Because where else can you diversify? You can't just put everything in equities. But over the short term, we've also experienced that pain. Do we think there's a breakdown in the relationship and this is no longer relevant? Absolutely not. We actually think for where things are at the moment, that relationship is said to be stronger because yields have moved up higher. So now we're in a position, we've seen a bit of a reset on valuations, we've seen a little bit of a reset on this, and now things look a little bit more attractive. You can go back to your conventional diversification, you can go back to expecting some returns out of your offshore equities, for example, or offshore bonds. And you can see that here. So this is just the nominal yields out of the US 10-year. And this is the US 10-year in real terms. And you can see they had nowhere left to go. I mean, this was one of the easiest things to actually explain to our advisors, that there will be an issue here over time, but we need to have that in the portfolio. So expect some turbulence. But what we have seen is the yields go from that 1.5 to 4.1, and that's going to move higher. And we expect that to go in excess of 5. And if it goes to in excess of 5, it's on that line, which seems broadly on, say, it's average over the last 30 years. So it becomes more palatable. But if your yields are running at 1.5, they've got nowhere left to run. So they could only really go up. But as I say, we're in a much better position now. If you look at the cycle of equity, US equity outperformance, this is what I mentioned earlier, and I said I'll show you a few charts. These are the charts. So this is what the US have done. US has outperformed for 15 years. It doesn't mean that the US is a sustainably better country, better business, everything else, only investment out there. We think it is because the last 15 years have been fantastic, but they do end. These cycles do end, and this is where the rest of the world essentially outperforms the purple ones, and we think we are way overdue for that. And this will be, so we expect some purple, as a consequence of US underperforming and then other areas outperforming again. So a combination of the two factors. If we look at the valuations of international equities, for example, this is the price to earnings ratio discount versus that of the US. And we can see here that international equities relative to US equities haven't been this cheap in 20 years. So the good news is there are opportunities out there. And the playing field, as I said at the beginning, has leveled. And if you use the other valuation measure dividend yields, we can see that the dividend yield premium that you get in international equities over US equities is quite significant as well. And then the last slide from me, global equity valuation. So this looks at the various regions around the globe, where the current multiple sits, but we say be careful of what consensus earnings expectations are. They don't always overshoot. Funny enough, they overshoot in the areas that are doing well, like the US, and they undershoot in areas where the earnings forecasts are probably too conservative. So that's also something that you need to take into consideration. But the fact that the current yields or multiples are below the purple, which is the 25-year average, and at the lower end of the ranges, tells us that there are still significant opportunities abroad as well. And it does say that the risks that we saw in the US as the markets have sold down has muted. It's not to say that it's over just yet, and we would definitely feel more comfortable if there was a little bit of margin of safety, but it does look a lot better. And we think the prospects from here are quite attractive. Thank you very much. Appreciate your time. Thank you very much, everyone.
Well, I'm sure you are feeling a bit like me, like I feel like I've got a sense of control about where the world is and where the world is going, and that I can make sense in a financial plan. So Adriaan, thank you very much for putting that sense of ease on us, and I know that we are in good hands with PSG Wealth. Thank you very much for joining us today to the audience, and I hope you have a great day further. Bye-bye.